Rob's Child. Nothing I say is investment advice. Everyone is wrong about stocks and bonds. October 2023. I'm going to start this conversation talking about the unbelievable arrogance of people that talk about stocks and bonds. And it starts with Jim Cramer, really. He's the biggest one, most famous, because he's really, well, I don't know if there was anyone before him, but he's the first one that I've known of. Sort of a celebrity. Now we have lots of people online that believe they can tell the future about the prices of stocks and bonds and or any sector, any area of markets. And so the first part of this video I want to talk about is to understand that it's not a bad idea to believe no one. It's good to get educated about yourself. It's good to understand when things are priced higher than what you can calculate as their intrinsic value or lower than their intrinsic value. Nothing really beats the Graham way of looking at things. Once you read this book, you can see my series on it. You can read the book yourself. You'll get such a much clearer picture at like how all of this really works. But I wanted to sort of do this video to give a clearer idea for people out there to understand what stocks are and what bonds are and what the prices mean, what they represent. I'm going to mention this also at the end of the video. No matter how much knowledge you have over the pricing of things, it's important to remember, like what Gareth Soloway says sometimes, is that markets are not rational. They're not priced by AI. They're not priced by even, professional money finance people. There's too many retail people. There's too many regular people that have control of their own assets, and to have the markets really make sense without emotion. The point being is that when you see the price of a stock moving, or a bond, or even bonds, even the bond market, it's not a reflection of what's real. It is, because that's the price you can get for it that day, but it doesn't represent exactly what's going to be happening going into the future. It never does, and no one knows if prices are going to go up and down at any point, and by how much. It's important to understand that these things are caused by humans, by emotional beings. If you really could accurately predict the price of securities with complete surety, what's going to happen next month, even next year, where is the market going to be, you would make yourself the wealthiest person in the world by 20-fold within not that much time. Because if you're right, you can use future contracts and leverage yourself up to infinity, and the fact is that no one can do that. There's short-term traders that aim for 1% on something. There's things people use that can increase their probability for earning money short-term, but outside of that, it's not practical to try to predict what emotional people are going to do with the prices of stocks and bonds, and that's the main reason I want to start and title this video as such, saying that everyone is wrong about stocks and bonds. Again, you have people that are telling you, buy this stock, buy that stock, short this stock, short that, get out of this, get into this. Like they know what's going to happen tomorrow, next week, in a month. And even if nothing happens, let's say all the market data coming in matches exactly expectations. There's no news to change anything. People are still emotional. You don't know, there's way too many factors involved with people's psychology. It's a kind of a thing where, the idea of, the idea where a butterfly can flap its wings on the other side of the world, and because of that one eensy extra bit of wind, there's now a hurricane on the other side of the world several months later. Whereas if they didn't make that one move, and so that's I believe that can exist. One thing, someone gets angry at someone in traffic, someone cuts Powell off on his way to talk about what they're going to be doing with interest rates, and he's like, oh, you know what? I'm going to make it sound a little more hawkish, and then it drives markets down. Like, you don't know the smallest thing that can happen. People are emotional. Emotion drives markets. I'm saying that this is an important, very important thing to understand, that, we can't, as humans, predict market prices because of the volatility of human emotions. It's a very important thing to understand. But the bulk of this video that I'm intending to create here is to try to give a little bit of calmity to anyone that's interested in trying to manage their own assets and buying or selling stocks and bonds. And I wish that I had known really the real core basics of how investing works a while ago, which is why I kind of wanted to make this video. It's very important, number one, to understand, and if you already do understand, then to have this message repeated in your head again, because when stocks are getting like a little whiffy, we get emotional. It's normal. But let's go over the important core points of what investing is all about. So first we have to ask, what are stocks? What are bonds? Okay, let's go back to the basics. A stock represents payments that you can eventually get. I gotta pause for a second. Pause over. I'm back. So what do stocks represent? Stocks represent future payments. It's an ownership of the company. You own a piece of the company, and the people that own the company, hopefully the company is managed well to the point where eventually that stock means that you receive profit from that the company is making. You get the leftovers. Now, and then a bond is debt. So it's someone borrowing money. If it's a treasury bond, it's the government borrowing money from you. They're saying, give me your money. Here's this bond. We guarantee we're going to pay you back with interest. So then you get your money that way. So when you're buying a stock, you obviously are taking a higher risk than when you're buying a bond, because you're hoping there's going to be some money left over for you to get. You're hoping the company is not going to go bankrupt. You're hoping the company is making earnings, and many companies aren't even making any earnings. And so, but the idea is that eventually they will be making earnings. That's the reason you would invest in a company that doesn't have any earnings. Although Graham might disagree on that point. But if the growth is strong enough, if the prospect, it's more of a gamble, and a lot of times it pays off. But let's get down to the core basics of how this all works. So I want to just compare stocks right now to bonds right now. Right now, the 30-year Treasury bond yields something like 4.5%, a little bit over, between 4.5% and 5%. Now, what about a company? A company, if you see the PE ratio of 20, then that means the company is making the same, basically, as that 30-year bond. It's making 5%. it says it's earning 5%. Now, most of the time, a company with a PE ratio of 5%, they're not giving you that 5%. That 5% is going other places, but at least the company itself is making 5%, and that's good. So now the question is, do I want a bond that can pay me 5% now, or do I want a company that's earning 5% for itself and it's not actually paying me anything? Well, let me tell you, if you're buying a stock with a PE ratio of 20, just flat out, we're not talking about any growth involved, that money is not coming directly to you. Well, why would you want that? Well, the idea is that hopefully the company is growing. So then that 5%, let's say it's $5 out of a $100 stock. The idea is that, next year it'll earn $6, $7, $10, $20. You need to have earnings growth in order for that stock to be really worth bothering to basically gamble your money into, in order to, you have to have growth. If you don't have that earnings growth on that company, then buying a company when its PE ratio is 20, it's not doing you any good in as far as intrinsic value. Now, again, I think that can be enough to cover that section. That's just one basic way of understanding what a stock is versus buying a bond. But again, the bigger picture here. So then the prices of, before I go on, why are stocks always so much more expensive than that usually? Well, have been. They haven't always been that way. But it's because the expected earnings is going to be growing and growing and growing. And I say that with a little bit of hesitation because we're in a point where the Fed is trying to slow down the economy on purpose, and a lot of stocks right now are priced as if their earnings are going to keep going up and up and up. And yeah, it's scary, it's problematic, but at the end of the day, everyone is wrong about stocks and bonds, because the price of stocks is not determined by its PE ratio, its real supposed value. It's actual value even in the future. I mean, let's say you had a looking glass into the future. You could see in 50 years that, some little company is making a looking glass. Let's say you can only see in 50 years from now that a little tiny company, for example, exists today and its market cap is only $500 million. And in the future, their earnings are, $60 billion in 50 years from now. Does that mean you should buy that stock right now? Well, your first instinct is, yeah, of course. Why wouldn't I buy that? Just buy that, load up on it for the rest of my life. But what do you think the price is going to be 5 years from now, 10 years from now, 15 years from now? Okay, it's probably going to be valuable in 50 years from now. But what if all of that growth happens only in the last 5 years? You don't know when the price is going to be going up of that company. You don't know when the spike of earnings is going to be happening, for example. So even if you could see the future, a jump ahead in the future from 50 years, my point is just that, banking on that right now is as being a great investment for a shorter time horizon is not a dependable thing to necessarily count on. All we're really left with is, calculating out intrinsic values. And, if a company has growth, if a company is, has growing earnings, it has a PE ratio that's below 7, that's a no-brainer. That's like you buy it and you wait for people to be like, oh yeah, this company's, paying a 20% dividend. Uh, huh. Well, maybe I should buy some of that, and then the price, and then it finally equals. It finally, the market finally says, oh yeah, it's actually worth this much, and that's the beauty of the Graham way of investing. Finding things that are clearly worth more money than what the emotional dumb people that are trading these things for are pricing it at currently. So that covers those areas. I think that's pretty much everything. The main takeaways that I wanted to put out there on the internet today is that prices are not decided by intelligent people. I used to think that they were. I used to think, oh, well, if a stock is really cheap, then why would it even be cheap for long? Because obviously the smart people are going to buy all the cheap stocks and then it's going to go up to the real actual value. It doesn't actually work that way. There's too many dumb people out there. There's too many emotional people that control the prices of these things. The market is emotional. Even day traders, market makers, professional investors, people that people with varying macro views, and then you have institutional players in there that are forced to sell or buy things based on certain things that happen, and that can also affect prices of things. But again, they have their own baskets, and everybody has different opinions about all these things. And at the end of the day, markets are clearly, if you look throughout history, they're clearly more emotional than they are logical, and so that's why everyone is, and I'm not saying everyone is wrong about stocks and bonds today. I'm saying everyone is wrong about stocks and bonds forever. All of the history of the world and all of the future of the world, everyone is always wrong about stocks and bonds. And that's all for this video. Hope you enjoyed. Rob's Child.